Okay, so you want to mine Bitcoin. Here's the first thing to understand. You're not really in the business of finding treasure. You're in the business of burning electricity as fast and as cheaply as possible and getting paid in Bitcoin for doing it. Strip away the mystique, and Bitcoin mining is an industrial energy business wearing a tech startup costume. It has more in common with an aluminum smelter than with a software company, and the sooner you think of it that way, the sooner the economics actually make sense. Let's talk about how you'd actually start this, because almost nobody begins with a 500-machine industrial facility, and treating that as the starting point is exactly why so many beginners never make it past their first electricity bill. The realistic entry point is one of two paths. The first is buying a handful of machines, sometimes just one, often on the used market where prices swing hard with the Bitcoin cycle, and running them yourself somewhere with genuinely cheap power and enough ventilation to handle the heat, which for most people ends up being a garage or a small rented space rather than a spare bedroom. The second, and increasingly the more common way people actually get into this without 6 figures of upfront capital, is hosting. You buy the machine, but instead of running it yourself, you ship it to an existing facility that already has the cheap power, cooling, and maintenance staff solved, and you pay them a flat monthly fee per machine to plug it in and keep it running. Hosting trades away some margin for skipping every one of the infrastructure headaches described later in this video. Before spending $1 on hardware, the actual first move is doing the electricity math honestly. Whatever power rate you can genuinely access, whether that's your home utility bill or a hosting provider's quoted rate, determines almost the entire outcome before you've bought anything. Because a residential electricity rate makes this an almost automatic loss once you account for a machine's constant power draw running full tilt, every hour, forever. The founders and hobbyists who actually make this work calculate their break-even cost per coin, using the current block reward and current network difficulty, before they ever place an order, and they join a mining pool from the very first day instead of trying to solo mine. Since solo mining, even a single machine against a global network is closer to buying a lottery ticket than running a business. The single most common early mistake is buying hardware during a price euphoria spike. When everyone else is piling into the same trade at the same time, machine prices themselves get bid up by all that new demand, and the break-even math is at its absolute worst right when it feels most exciting to jump in. Here's the actual mechanism. Roughly every 10 minutes, the Bitcoin network produces one new block, and every miner on Earth is racing to be the one who finds it, using specialized machines called ASICs that do nothing but guess random numbers billions of times a second, over and over, all day, every day. Whoever finds the right number first gets the block reward, and everyone else's electricity for that 10-minute window was spent for nothing. Since the April 2024 halving, that reward is 3.125 Bitcoin per block. Every 4 years, like clockwork, on a schedule written directly into the protocol, that reward cuts in half again. It has gone from 50 Bitcoin to 25 to 12.5 to 6.25 and now to 3.125, heading toward 1.5625 at the next halving. That halving schedule is the single most important fact in this entire business, because your revenue gets cut in half on a fixed calendar, whether your costs go down or not, whether the Bitcoin price cooperates or not. Since finding a block on your own is basically a lottery ticket, and an increasingly unlikely one as more machines join the network, almost nobody mines solo anymore. You join a mining pool, combine your hashing power with thousands of other miners around the world, and split the rewards proportionally to how much computing power you actually contributed, minus a small pool fee, usually somewhere between 1 and 2%. The pool smooths out the randomness. Instead of a huge, unpredictable payout once in a blue moon, you get small, steady, predictable payouts that scale with your machines, which is really what you want if you're running this as an actual business rather than a lottery. Choosing a pool matters more than most new miners realize, too. A handful of pools, names like Foundry USA and AntPool, collectively control a large share of the entire network's hash rate, and that concentration is itself a quiet risk to the whole system, since it means the actual decision-making power over which transactions get included in a block sits with a small number of pool operators rather than being spread evenly across every miner. For an individual operator, the practical concern is smaller but still real. Pool fees, payout structures, and reliability vary, and a pool with poor infrastructure or opaque payout formulas can quietly cost you real money every single day without you noticing. Now let's talk about what it costs to actually get into this, because the barrier to entry is a lot higher than people assume from watching a YouTube video about a guy running one machine in his garage. A single modern ASIC miner, the kind serious operations run by the thousands, costs somewhere between $2,000 and $5,000 depending on its efficiency and how recently it was released. And efficiency is everything here, because every machine has a power draw, and that power draw is your permanent, unavoidable, 24-hour operating cost for as long as that machine is plugged in. Say you're running a modest operation of 500 machines. At roughly $3,000 a unit, that's $1.5 million in hardware before you've mined a single coin. Each machine might draw around 3.2 kilowatts under full load. 500 of them running continuously is 1.6 megawatts of constant power draw, 24 hours a day, 7 days a week, with no off switch, because every hour a machine sits idle is an hour of zero revenue against hardware that's already depreciating. At an industrial electricity rate of 5 cents per kilowatt hour, which is actually a good rate you'd need to negotiate directly with a utility or locate near cheap, often surplus power to get, that's roughly $2,000 an hour, close to $17 million a year, just in electricity. Electricity isn't a line item in this business. Electricity is the business. Everything else is just logistics around it. Then there's everything that has to exist around the electricity. Industrial space and steel racking to physically house thousands of machines. Cooling, because thousands of ASICs running at full tilt generate enormous, continuous heat, and you're choosing between cheaper air cooling with high-volume fans, or more expensive but more efficient immersion cooling, where machines sit submerged in a thermally conductive fluid. Transformers and heavy electrical infrastructure to actually get that much power safely into a building, which alone can run into the millions of dollars for a serious facility, sometimes requiring you to build a direct substation connection. Maintenance staff, because ASICs fail constantly under that kind of sustained load, fans die, boards burn out, and every hour a machine sits offline waiting for a technician is revenue you don't get back, ever, because that 10-minute block already went to someone else. So what do you actually get paid for all of this? Your revenue depends on 3 things stacked on top of each other, multiplying together: the Bitcoin price, the current block reward, and your share of the total global hash rate. That third variable is the brutal one, because you're not just competing against the miners who exist today. You're competing against every new, more efficient machine that gets plugged in next month, next year, by operations all over the world with access to cheaper power than you. The network's total hash rate has climbed into the hundreds of exahashes per second, and every time it climbs, your existing machines produce a smaller slice of a fixed pie. This is called difficulty adjustment, and it recalculates roughly every 2 weeks specifically to keep block production steady no matter how much hardware gets thrown at the network. More competition doesn't just eat into your margin the way it would in a normal business. It mathematically guarantees your machines earn a shrinking amount over time unless the Bitcoin price rises enough to compensate for it. You are running as fast as you can, permanently, just to stay in place. This creates a specific kind of business risk that's different from almost anything else in commerce. You're not betting on whether Bitcoin succeeds long-term, the way an investor might. You're betting that your specific cost per coin mined stays below the market price of a coin, continuously, every single day, while a global arms race of more efficient hardware keeps pushing that cost structure against you. And while the reward itself is scheduled to keep shrinking on a clock you have zero control over. It's a business built on a treadmill that speeds up automatically. There's another dimension to this cost structure that catches new miners off guard: hardware depreciation. Unlike a factory machine that might run productively for 20 years, an ASIC miner has a brutally short useful life, often just 2 to 3 years before it's obsolete, not because it breaks, but because newer, more efficient machines make it unprofitable to run. You're not just paying $2,000 to $5,000 for a piece of equipment. You're paying that for what's effectively a rapidly decaying asset, one that needs to earn back its entire purchase price, plus a profit margin, before more efficient competitors push the network difficulty up high enough to make your specific machine mine at a loss. That means every purchase is really a bet with a clock attached. Can this machine earn more than it cost before it becomes obsolete? Miners who buy at the top of a bull market, when everyone else is also buying and manufacturer prices spike, often never recoup that investment at all, while miners who buy during bear markets, when hardware is cheap and desperate sellers are unloading fleets, can buy the exact same machine for a fraction of the price. Timing your hardware purchases against the broader market cycle is arguably as important as any operational decision you'll make. Geography matters just as much as timing, because this is fundamentally a business that chases cheap electricity wherever it exists, and that chase has reshaped the entire industry more than once. For years, a huge share of global Bitcoin mining was concentrated in China, drawn by cheap coal and hydroelectric power. Then in 2021, the Chinese government banned cryptocurrency mining outright, and almost overnight, an enormous portion of the world's hash rate had to physically relocate. Shipping containers full of ASICs left China for Kazakhstan, Russia, and especially the United States, particularly Texas, which offered a deregulated power grid, cheap natural gas and wind power, and a regulatory environment that welcomed miners instead of banning them. Texas's grid operator, ERCOT, even started paying large miners to power down during periods of peak demand, turning miners into a kind of flexible, on-demand energy buyer that helps stabilize the grid and getting paid real money for the privilege of temporarily turning their machines off. That single migration event proved something important about this industry. Because mining facilities are just buildings full of machines with a power connection, they can move to wherever electricity is cheapest and most welcoming almost overnight. And the operations that survive long-term are usually the ones that treat their physical location as a constantly reassessed decision, not a permanent home. Which brings us to what happens when that bet goes wrong, and there's no better example than Core Scientific. By 2022, Core Scientific was one of the largest Bitcoin miners in North America, publicly traded, operating a huge fleet of machines across multiple states, widely seen as one of the more serious, professionalized players in the industry. But it had financed a large part of its hardware expansion with debt, buying more and more machines on credit while Bitcoin was near its all-time highs and the math looked easy. Then 2022 happened. Bitcoin's price collapsed through the year, energy costs spiked amid a broader global energy crunch, and the company was locked into massive fixed obligations, both from its equipment financing debt and from long-term power contracts that didn't move even as its revenue did. Fixed costs don't care what the market is doing. In December 2022, Core Scientific filed for Chapter 11 bankruptcy. One of the biggest, most sophisticated miners in the country, brought down not by a hack, not by a technical failure, not by regulation, but by the oldest problem in any capital-intensive industry. Too much fixed cost, financed by too much debt, colliding head-on with a price crash it had no way to control. The company eventually restructured and emerged from bankruptcy in January 2024 and remarkably pivoted a significant part of its infrastructure toward AI and high-performance computing hosting, striking deals to lease its power and data center capacity to AI companies instead of, or alongside, mining. It turns out a facility built to deliver massive, cheap, reliable power at scale is valuable for more than just mining Bitcoin. And Core Scientific's survival ultimately came from recognizing that the actual asset it owned wasn't Bitcoin mining machines. It was industrial-scale power infrastructure, which could be redeployed the moment the mining economics stopped working. So what actually separates a mining operation that survives from one that doesn't? It's almost never the technology, because everyone can buy essentially the same handful of ASIC models from the same handful of manufacturers, mostly based in China. It comes down to three things. First, your electricity cost, locked in as low and as long-term as you can manage, ideally near stranded, surplus, or otherwise underused power sources, like flared natural gas or excess hydroelectric capacity, rather than competing for power on the open industrial grid. Second, your capital structure, meaning how much of your hardware is financed with debt you have to service no matter what Bitcoin is doing that month, because debt turns a bad quarter into an existential one. And third, your discipline about upgrade cycles, because running outdated, inefficient machines in a difficulty environment that only ever gets harder is a slow-motion way to mine at a loss without noticing until the losses have already piled up. So if you're actually weighing whether to get into this, the honest starting advice looks nothing like the 500-machine facility this video spent most of its time inside. It looks like running the electricity math first, on whatever handful of machines or hosting slot you can realistically afford, joining a pool from day one, and treating hardware purchases as a race against a difficulty curve and a halving schedule that never pause for you. Everything else, the industrial scale, the grid deals, the AI pivot, is just what this same business looks like after that first honest calculation gets made correctly, over and over, for years. Bitcoin mining looks like a technology business from the outside, with its specialized chips and its blockchain jargon. It behaves like a commodity business on the inside, the same as an aluminum smelter or an oil refinery. Thin margins, brutal global competition, and survival that depends less on being clever and more on having the cheapest, most reliable input cost in the room. The miners who last aren't the ones who bet biggest on the Bitcoin price going up. They're the ones who built a cost structure so lean it survives even when the price refuses to cooperate, for years at a time if it has to.